So we've all heard of a Roth IRA, a tax-free account that allows us to put money in, have it grow, and then not pay taxes. But it's some tax hacks that we use for our clients on an annual basis that allow you to actually make more money in your Roth IRA from a savings standpoint. So how do we do that? We're going to go over 3 tax hacks today to get you making more money. So before we get started, like, subscribe, share. In real life, I'm a certified financial planner, managed over $250 million in assets, but on these social media streets, we're giving information. Now, past performance does not guarantee future results, but prayerfully, this information we give you will help you transform your finances. Lego!
And you just wanna get paid, tired of making no money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you
a Roth IRA. A Roth IRA is an account where we can put up to $7,000 a year if we're under the age of 50, or $8,000 a year if we're over the age of 50 in that account. And that money's just going to grow tax-free all the time. There's some hacks, and we wrote down 3 hacks that actually allow you to make more from a savings standpoint, because when we save money, we actually make money. I say it all the time. Saving money is actually the more like making money, right? If I save $2,000 on my taxes and I don't have to pay Uncle Sam $2,000, that's money that's in my account. So now instead of having $8,000 because I put $2,000 to the IRS, I have $10,000. So when you save money, you actually make money, and that does not go towards your taxes. Because when we really make money from a working standpoint, goes towards our taxes. We save money, though. That's actually money that we actually make. We don't pay taxes on. But number 1, the first Roth IRA hack is tax-free withdrawals 59.5. So with a Roth IRA, we could take money out before the age of 59.5, and it is penalty-free. See, with a traditional IRA, we take money out of traditional IRA before age 59.5, we have to pay a 10% penalty because we're not 59.5, and taxes. With the Roth IRA, you actually get to take out the money that you put in and not pay taxes on it. But here's the hack. If you put money in and you take out the same amount of money that you put in, so let's say we put in $5,000 and we take out $5,000, we don't pay a 10% penalty on that. But guess what happens to the money that is in the account that we made money off of? It stays in the account and we don't pay taxes. So for an example, if I have $5,000 I put in my Roth IRA January of the year, and now the account grows to $8,000 at the end of that year, if I take out that $5,000, I do not pay penalties or taxes. But that $3,000 that stayed in my Roth IRA, that made $3,000 tax-free. And going forward, that money will continue to grow tax-free. So theoretically speaking, we could put money into the Roth IRA, and the same money that we put in, we can take out. No penalties at all. But the money that grew stays in the account. So every single year, so theoretically speaking, let's say we do that for 10 years. We put in $5,000 a year. Well, that is $50,000 we put into our Roth IRA over a 10-year time period. And let's say we took it out. But every single year, we made $3,000. Well, over 10 years, that's $30,000. With compounding interest, that's $52,000. So we put in $5,000 a year. We took it out. It's $50,000. It grew by $52,000. Now we have $52,000 of tax-free money that stays in the account, even though we took out $50,000 over those 10 years. Now, of course, if you don't need the money, don't take out the money. We want to keep it in because the more money you have in the account, the more it's going to grow. But from a tax hack standpoint, we could put in $5,000 in the year, take out the $5,000, and then the $3,000 that it made or more or less, if it's invested not properly, then whatever we made on top of that stays in the Roth IRA, and that grows tax-free. So that is tax hack number one. Number two, you can use it if you're a first-time home buyer. Now, caveat to this. The caveat is we have to have our Roth IRA for at least 5 years, meaning we can't put, $5,000 in the first year, $5,000 in for the second year, it's $10,000. Now it's at $14,000. In the year 3, we take out $10,000 of the $14,000 and not pay a 10% penalty. No. Doesn't work like that. Have to have your Roth IRA established for at least 5 years. All right, so this is more of a longer term play. So a person who is straight out of college knows they're going to buy a house, hopefully 6-7 years down the road, or a person out of high school, right? Then you want to do it. Or for all those parents out there, you can have your child have a Roth IRA if they have any earned income. They got a summer job, they're cutting the grass, they're working at Chick-fil-A, you're a business owner, they work for your business. You can put money in their Roth IRA. Anybody can have a Roth IRA if they have earned income. So with that being said, to help with the taking out $10,000 to buy a new house, that clock starts. So if I am going to buy my first house, now your second, your third, your fourth, anything after that, not so much, can't do it. But our first house that we buy, we can take out $10,000 from our Roth IRA and not have that 10% penalty. Had to have it for 5 years. But as I said, anyone who has a child that earns income, you would open up that Roth IRA, and whatever they made up to $7,000, you could put it in every single year. So that's tax hack number 2. Tax hack number 3 is we also can do Roth IRA through our employer. So we have a 4K, and the thing with the 4K is that we put money in and the company puts money in. It's free money compared to a Roth IRA or a traditional IRA at a financial institution. The employer is not matching, right? If I put in $5, nobody, in this case, the financial institution is going to give you $5 free. It doesn't work like that. So it's always best from a retirement standpoint to start with your employer because your employer matches. Well, from a limit standpoint, it's a few limits because a Roth IRA, you can only do $7,000 before 50, after 50, $8,000. There's also an income limit that you don't have at your job. The income limit is if I make $150,000 or more and I'm single filing, I cannot do a Roth IRA with a financial institution. If I make $236,000 as a married couple filing, I cannot do a Roth IRA at a financial institution. But at my company, I can. So you need to tell your employer that you want to switch from a traditional to a Roth. Again, switch from a traditional to a Roth 401k. 2 things happen. Number 1, doesn't matter how much money you make. If you making money now, you will never, ever, ever be broke if you budget properly. But doesn't matter how much money you make, you can put money into that Roth IRA. And number 2, you don't have that $7,000 buffer or that $8,000 buffer if you're age 49 or younger at $7,000 or above $50,000, $8,000. You know why? Because with the Roth 401k, the same contribution limits apply as if it was a traditional 401k. See, with a traditional 401k, you could do up to $20,500 a year if we're 49 or under, not $7,000. But you can also do the same with the Roth 401k. You can do up to $23,500. Now, if we're over 50, even better. We have what we call a catch up. And that catch up is an additional $7,500. So it's not 23,500. It's actually 31,000 in totality. So if I'm over age 50 in my either traditional 401k or my Roth 401k, I can do up to $31,000 a year. And all $31,000 of that money is growing tax free. So I can really maximize my tax free earnings. Remember, with a Roth IRA, any money that you put in, you can take out the same amount of money with no penalty. Well, with a Roth 401k, it doesn't work like that, because when you're with your employer, you cannot take money out. If you're not with that employer, stipulations is the 10% penalty. It has to be in a Roth IRA. So we can't do the put in, put out, introduce yourself. Can't do that. Can't put in and put out. So that is a bad thing. But if it was up to me and I had the cachet, I'd rather put $23,500 in something tax free compared to $7,000. Or if I'm over 50, I'd rather put in up to $31,000, no minimum, up to $31,000 in something that grows tax free compared to $8,000. So that is the hacks of a Roth IRA. But now we'll get to the juicy part. How much money will we make if we're 30, 40, and 50 if we just max it out for 10 years? A Roth IRA, not a 401k. So if we have a Roth IRA, we max it out for 10 years between 30 or 40, how much would that be? 40 or 50, how much would that be? And 50 to 60, how much would that be? Let's look. But here's the kicker when it comes to tax-free money. The younger that you are or the earlier that you start, the better. So we're going to show you how much you'll make if you start doing $7,000 a year in your Roth IRA from 20 to age 30 and stop, and how much you'll get at age 60. And then if you started to do it at age 30 and you did it for 10 years and stopped at age 40, how much would have grown to age 60? And then if you were 40 and then stopped at age 50, how much would it be? And I show this because it's not timing the market, it's time in the market. And having something like this grow tax-free over time, you get to the bag. So for my 20-year-olds, I'm telling you guys now, do this or have your parents help, right? So if I am 20 years old and I put $7,000 a year in a Roth IRA from age 20 to age 30 and then stop. So I'm putting in no more money after age 30. Now, if you can put in more money, then definitely put in more money. But if we don't, we just stop at age 30, do real estate, do other things, is have that money grow tax-free. Well, we can take out, in that instance, up to $70,000 a year with no penalties. But we just let it grow. What's going to happen? At age 60, you will have $1.9 million. I said it again, y'all. $1.9 million. Now, this is in a regular old index fund making 10%. We have index funds like the NASDAQ that has done more, or the average more than 10% over the past 20 years. And things like the Dow Jones has been a little bit less. But if we're in an index fund making 10% a year, so if we're in stocks that are rocking and rolling, making more than that, you're making more money. But if I'm 20, I put $7,000 a year in until I'm 30. And when I stop at age 30, at age 60 in that index fund making 10% a year, I have $1.9 million of tax-free money that I can take out all, and Uncle Sam can't penalize me or tax me. Now, if I'm 30, right, I wait a little bit. Now I'm going to do it at age 30. I do $7,000 a year from age 30 to age 40. And then I stop. So from age 40 to age 60, I'm just letting that money grow. Just grow. At age 60, that is $750,000. Still a lot of money, and it's all tax-free. So I can take all the money out at age 60, not have to pay taxes, or in retirement, just take off a little bit here, a little bit there. But you're not paying taxes. But do you see the difference? Starting at age 20 compared to 30. 1.9 million, 750. That is a $1.2 million difference. Even though it's 10 years later with the same money, the extra 10 years in the market gets you $1.2 million more. So it's not timing the market, it's time in the market. Now, what if you're in my age bracket, right? You know what I'm saying? Me, the 40 club, right? If we're 40 and put in $7,000 a year and then we stop at 50 and we just let it grow to age 60 and we take out money, it's going to grow, right? We put in $70,000, so making 10% a year. We stop at age 50. That, my friends, gets us to $289,000 of tax-free money. So almost $300,000. Now, better than nothing, right? 20 at 1.9 mil, 30 at 750,000, now 40 at 289,000. Huge difference. So timing the market, not so much. It's timing the market. That's why the earlier that we do, the better, or putting more money in helps even more. Now, what about my 50-year-olds? Huh? Still do it. Still do it. But at 50, we put it in. We retire at 60. What's going to happen? Well, we put in $70,000, make it 10% a year, compounding interest. Take it out at age 60. It's $111,000. Now, that's better than nothing. And we have a lot of clients call, say, hey, we want to start. And we start, but then we are super aggressive on them meeting their retirement goals, meaning they put in more money or find ways to pay off their debt, good debt and bad debt, right? Like credit card debt, bad debt, or aggressive in putting in money in their account so they can have more money. But if I'm 50, 70,000 in, 111,000 out. Still tax-free money of over $40,000. So those are the hacks when it comes to having a Roth IRA. As we explained, 1, free withdrawals before 59 and a half. 2, the first $10,000. If it's for my first home, I get to take out penalty free. And 3, I can do a Roth 401k and put even more money in, even though I make more money. So if you like this and other information from a tax strategy, investment, financial planning standpoint, like, subscribe, share our channel. We're here to help. And as always, let's make some painful or painless profits together, y'all. Peace.